Brandon, thank you for joining us. So my first rule of conference panels is always begin at the beginning, because when I was new to the space especially, I was the guy sitting in the back corner who didn't understand what happened after the first 90 seconds of the panel. So let's start at the very beginning here. For people who may not be familiar, what is the corporate treasury function?
It's evolved recently. The corporate treasury function is lately it's been to optimize yield. Given the downturn, given the economic downturn, given that VCs are not funding anyone right now, you're seeing more and more corporates, VC-backed startups, serve as mini hedge funds effectively with their cash. How can they optimize yield on it? So the treasury function used to be, payments, bank account, checking account, but now it's like we're all hedge funds is the idea.
A frightening and disconcerting proposition. So the traditional corporate treasury function, sort of BS before Satoshi, 2007 and before, was precisely the points that you just made. Kind of a staid and relatively, kind of mechanistic function where you'd manage accounts receivable, accounts payable,
right,
and manage all of that. Tell us what you've seen here in the digital asset era, particularly when people think of corporate treasury functions, they think of large corporates here in the United States and abroad. What does that mean today?
So in 2021, when interest rates were zero, inflation was high, people were looking for yield, right? I mean, you were losing 7% just on a yearly basis for being yourself, for doing nothing. So the corporate treasury function gravitated towards crypto market yield sources. There were over-collateralized offerings, there were unsecured offerings. Some of them were...
Unpack that a little bit for people who may not be familiar. Hearing them,
So the over-collateralized yield sources, for example, was, say I loaned someone $10 million. Before I loaned them that $10 million, they would give me, for example, $15 million worth of a digital asset, like Bitcoin or something like that.
And explain why you'd want to do that, get $10 million in cash for $15 million in assets.
Well, for me, it's really nice if I'm lending out that $10 million, because I'm actually holding more value than I've given them, and they're paying me an interest rate, which is very nice.
And they get liquid U.S. dollars or whatever.
Right. Yeah, they get liquid U.S. dollars. So there are people had such an appetite to borrow dollars in the bull market because there were low-risk ways to take advantage of inefficiencies in crypto markets, for example. So market making is an example of that. You have Bitcoin trading on,
And should we do the market making explainer as well?
Yeah, just at a high level, there are people who can take advantage of dislocations in the price of digital assets across different exchanges without taking directional risk. It's not like they're speculating that Bitcoin's going to go up or down too much. If Bitcoin's trading at 2% off on one exchange versus another one, you can buy it there, sell it the other place for relatively low risk. So people needed dollars for this, and that's what people were borrowing for a lot of the times. Yeah.
The market was very fragmented.
Exactly.
You had these bid-ask spreads. In other words, you had it selling on one exchange for a significant discrepancy when it was selling on another exchange, and people would go and they would essentially equalize those two prices and make a profit in the process. People needed liquidity. They needed the dollars to do that.
Exactly right. So that was a big backbone of some of the low-risk yields of 2021. Now, in 2021, there were also very high-risk yields, it turns out. So Three Arrows Capital, for example, was people would lend to them unsecured. So instead of people lending to them and getting a security blanket of 15 million in Bitcoin, like I just described, they would lend unsecured. Three Arrows would promise 10%, 12%, and they were just making speculative bets. They were taking directional bets. They were just buying things like Bitcoin or ETH or ST, other assets, and just praying. That's just absurd. But there is
so this was almost kind of a casino speculating environment, as you describe it.
Yeah, depending on who you lend to.
Three Arrows, of course, was not the only lending entity that obviously experienced problems and insolvency during that period.
Right, and a lot of the solvencies bubbled down from Three Arrows. A lot of people, solvency issues, a lot of people lent to Three Arrows, and they were holding the bag afterwards because they couldn't repay the loan. So Three Arrows was a giant fund, and they made very reckless decisions with how they borrowed the money. Now, that's different than the over-collateralized lending because collateral is king. If you hold more value than you've lent someone, the risk is much lower. You can liquidate them. You can sell the value of that Bitcoin if it ever meets a certain threshold, for example. Say that 15 million in Bitcoin becomes 12 million or becomes 11 million. You can sell it at any point. Yeah.
So you've lent out some amount of money that's less than the collateral you received, hence it's over-collateralized.
Yes.
And the idea here is if the price of Bitcoin begins moving against you, if your collateral, the collateral that you're holding, begins to decline in value relative to the amount of money that you've lent out, you have the ability to liquidate the collateral.
Exactly right. Even before that, there's what's called a margin call. So if you all are familiar with that term, it's you get to tell the people who gave you the collateral, hey, I need you to give me more collateral, because the value of the collateral you've given me has reached a threshold that's unacceptable to me. It's too risky. It's only 120%, whereas it used to be 150%. So they'd be on a shot clock suddenly. They have to give you more Bitcoin collateral in a certain period of time, or else you get liquidated, is the idea there. So that's a really powerful use case of things like Bitcoin, because it's very good collateral. The order books are very, very deep. You can sell a lot of it without moving the price too much, and it's very easy to transfer as collateral. It settles, it can settle in an hour, large amounts of Bitcoin.
Yeah, and you made a critical point there, the idea that it's a deep and liquid market, meaning that if you need to sell it for whatever reason, you can without having a huge price impact. And it's important to point out, I think, for people to understand that over-collateralization is not a panacea. If price moves very rapidly down, you may not be able to liquidate that collateral in time before you wind up essentially being underwater and having risk to have negative situations.
Exactly right. So a death spiral in the price of Bitcoin, if everyone loses faith in the price in Bitcoin, for example, that's the case in which even if you liquidate, you're going to at least incur a partial loss because everyone's trying to sell at the same time. So you're exactly right. That's a big risk factor of collateral in general.
And by the way, these types of functions that we're talking about were traditional corporate treasury functions that have existed long before the time of Bitcoin. Yeah. The opportunity here is that some of those market conditions make it more generating of yield, and therefore people are interested in doing it.
Exactly right. Yeah, the inefficiencies of the market. So unlike traditional assets, like we mentioned, Bitcoin trading is fragmented across exchanges, for example. Whereas a lot of other assets are centralized on one or two major exchanges, there's not a lot of inefficiencies to take advantage of. But the crypto markets, buying and selling Bitcoin, buying and selling ETH, in part because of regulation, in part because of just different exchanges in Asia versus LATAM versus the US, there are these inefficiencies, and that's why people, like hedge funds, can make a lot of money by borrowing money, even over collateralized, and market making and things like that.
So what's the use case? Pretend, let's role play this. Pretend you're a CFO and I'm a CEO who happens to be an English major like I was. And I go, okay, I get it. You're telling me that this is an interesting opportunity. In layman's terms, why is it an interesting opportunity?
So in 2021 was an interesting opportunity because inflation was eating your lunch. You didn't really have a choice but to find alternative asset yields. It was no longer a cute hobby to look for alternative asset yields. Finding relatively low risk things like over collateralized lending was attractive to just keep up with the loss of purchasing power. So you were losing maybe an engineer or two in hiring power for your company every year if you did nothing.
In terms of inflation.
In terms of inflation, exactly right. In 2022, what's really interesting is that the fiat instruments, so non-crypto related, seem to be the best risk return. I mean, the quote-unquote risk-free rate, a one-year T-bill is paying something like 4.1% if you hold to maturity. Now, you're going to be hard-pressed to find someone who wants to speculate on crypto market yields for 3% when the U.S. government is the counterparty to a T-bill at 4.1%. But the point is there's yield everywhere, and there's also inflation everywhere. So it's a question of how high are interest rates, what are governments willing to pay? In low-rate environments, it tends to be the crypto market yield sources, which are very attractive, and in high-rate environments, the government hasn't failed yet.
And so what are they now on a comparative basis?
Yeah, so if you're over-collateralized lending market has shrunk dramatically right now in the crypto markets. As you can imagine, people are not interested in that as much as the T-bills. So the T-bills are 4.1%, and it's difficult to find people who want to borrow over-collateralized right now in the crypto markets. Basically, the risk-free rate, quote unquote, has sucked out a lot of the liquidity in the crypto markets in general. People don't want to participate in DeFi as much because they could be earning 4.1% elsewhere, right, from the government. They don't want to gamble for 7%, for example, potential yields in a DeFi protocol. The risk, there has to be a premium to the risk-free rate that's attractive enough.
And this is the yield spread.
Yeah, exactly right.
And where is that today?
If you want to go unsecured on DeFi protocols, I've seen things like 8%, 9% right now. But everyone's kind of skittish right now, so you still are seeing a huge flight to safety. You're not seeing VC funding as much. Even seed rounds are getting lower and lower. So you're just seeing like a good old flight to cash right now, as you can imagine, cash and cash instruments like T-bills.
So now that we've set the stage, we've set a little bit of the context for the framework about the way this works. Talk a little bit about what you guys do at Meow.
Yeah, so in 2021, like I mentioned, when interest rates were zero, we offered a compliant way for corporates to participate in yields from crypto market sources, over-collateralized offering, things that they couldn't do on their own. They don't want to be holding Bitcoin, margin calling, liquidating Bitcoin. We did that for them in a compliant way. 2022, when interest rates went down, we started listing things like T-bills through our broker-dealer partner. So we're a one-stop shop for CFOs, for startups, for anyone really, to pick the yield source of their choice, whether it's a crypto market or whether it's a fiat instrument. This industry did not exist, 5 years ago, 6 years ago. The treasury startup did not exist because interest rates have always been zero. But now it's a very real thing. We have companies that are profitable because of the yield that they have on us that have no hopes of having revenue right now. So.
Well, that's a scary thought.
Yeah.
But,
Yeah.
but the general point, I think this is an important one. Essentially what you did was you created a digitized platform for people to search for yield at varying levels of risk and varying levels of return as a consequence and in an automated way. Prior to this, essentially the way corporate treasury functions worked was there were a bunch of folks sitting at desks with phones calling broker-dealers and actually
Right.
in a very highly manualized way, jotting things down on yellow legal pads and sending email to do this. This allows you a kind of a traditional interface like you might see at Charles Schwab, for example, and you can do this in a programmatic and straight-through way. By the way, talking of which, I think we have a slide of precisely that dashboard.
I think we do too.
We'll get to it eventually, I'm sure. But walk us through the non-existent slide. Now, tell us a little bit about what it would look like and what you would see if you were to log into the platform.
It's such a good slide, let me tell you. If only you could see it.
Someone right now is furiously fumbling with a laptop like, oh my God, my heart is at 120 beats per minute.
So I mean,
looking for
there
this
hasn't really been a dashboard. Like you said, it's all been calling people.
Yeah.
There hasn't been a dashboard that shows you 1 month T-bill, 3 month, 6 month, 1 year, crypto market yield source, credit mutual fund, commercial paper.
And by the way, for people who say, well, I can go on CNBC, for example, and see those yields, in a chart, and I can see that, but this is the ability to actually purchase them from a corporate.
Exactly right. Yep. It's one click, deposit instructions, et cetera. You can allocate. We want to do away with that kind of role. We want to automate away, very respectfully, of course, the CFO and VP finance role as much as possible.
It's a really tough sell to a CFO in the audience right now.
This is good. Let's all we should all get in on this early, right? But no, I mean, when you get to bigger and bigger multinational companies, of course, it becomes more complex. But for the Series A through D market, it's very doable. I mean, you don't need to be an expert in calling people like OTC. You can do it programmatically with QuickBooks integration. You can add users to the account. There's a lot you can do with this automated suite that we built.
Yeah. So talk through some of those functionality.
Yeah. So, for example, like if you wanted to participate, 20% of your portfolio in a T-bill. I think there's a slide. Yeah.
It's your slide.
Let me see. There we go. Okay, so this is an example of the T-bill portion. So you'd be able to deposit into any of those durations. It would go directly to our broker-dealer partner, custody of BNY Mellon. And then there's the high-yield tab, for example. And then in the next couple of weeks, there's going to be a commercial paper, corporate bonds, credit mutual funds, everything from one dashboard. Now, again, I can't stress enough that this kind of company did not exist in history because of the rate environment. There was no concept of earning yield or putting your balance sheet to work when rates were always 0%, 0.5%, 1%. Like, what could you do? But now with inflation high, it's a meaningful part of every company's appetite right now.
And they probably have to participate more actively because it's not just that rates are rising, they've become more volatile. So you have to deal with managing yield and roll off and all of that sort of thing.
Exactly right, and that is where a VP finance or CFO comes to play right now. So there's no automation right now, so it's picking and choosing what makes sense to you for your company.
And the other interesting aspect of this is that you can integrate essentially treasury functionality with much higher yield digital assets across kind of a continuum of risk and yield.
Exactly right. Yeah, some of the more ambitious companies will do things in crypto markets, with 20% of their balance sheet. A lot of them don't touch it. Some people want 5%. It's up to the company and how familiar they are with the instruments ultimately.
One of the other interesting things that's happening here in the last week or two is changes for the Fair Accounting Standards Board, the way that they treat digital assets, which integrates very meaningfully into this conversation.
Yeah, so I'm not an expert accountant, but I do know, my co-founder is.
I'm not even an amateur accountant.
I do know that they're being treated as fair value now. So I think you have to do all sorts of bells and whistles initially to account for having digital assets on your balance sheet. So forget about yield sources for a second. If you wanted to buy Bitcoin as a corporate or buy ETH as a corporate and hold it on your balance sheet, there were all sorts of innovative things you had to do to account for that in a compliant way with your books. But now they're treated as fair value, which makes it a lot less complex. And actually studies went out, they did polls of the biggest companies in the world, they said, what's the biggest reason you're not holding crypto assets on your balance sheet? It was the accounting implications. It was the accounting nightmare. Now, this news came out, I think, 3 or 4 days ago. So if that really, is accurate, that could be a tailwind to a lot of companies holding these assets on the balance sheet. I don't really have I'm not sure. I don't really have a directional bet I'd be willing to take on that, but it could be a tailwind.
Yeah, but the general idea is that if you're a CPA with an interest in crypto, this news has made your heart sing because it's dramatically simplified the reporting requirements for holding these types of assets.
That is true. This is bearish news for for a lot of companies and CPAs. Bullish news probably for the industry and people who want to own the assets.
What is the overall trajectory of this framework that you have as you think about corporate treasury functions? What's the role of blockchain in the system? Are you guys using blockchain technology on the back end, or is this just something that you're facilitating the purchase of digital assets that are blockchain based on?
Not really. I mean, there's so many companies out there that just try to throw blockchain on a problem, and it just makes no sense, right?
So true.
You want to touch it as it's kind of a swamp, if you're not doing it right. You need to know why you're touching the blockchain in the first place. Is there a practical reason to be introducing crypto to your business line? The practical use case for us in 2021 was offering these yield sources that offered potential yields that could almost keep up with inflation at the time. In 2022, the fiat instruments are most appealing, as you can imagine. I do think the innovation, one of the only product market fits that we've seen in crypto, and I'm bullish crypto long term, just to be clear. There's Bitcoin as a store of value. I think it's the greatest in history personally. And then there's USDC. So USDC allows you to pay people internationally way better than FedWire, way better than ACH, way better.
These are the two existing systems for transferring money here in the United States between financial institutions, ACH and FedWire,
Right.
ACH being net, FedWire being gross.
Exactly right, yeah. So I think those are real innovations, Bitcoin, USDC, that's on Ethereum, obviously. And the rest of it, I mean, to date, it's been a vessel for speculation, right? NFTs are a vessel for speculation. Coinbase is very popular because people are speculating. OpenSea is popular because people are speculating on the value of NFTs. I do think more of the financial system is going to go leverage on-chain functionality because you can cut out middle people, useless middle people. Without pen and paper, without making phone calls, you can interact with your counterparty directly, which is very nice. Right now, we're in the Bitcoin USDC world, in my opinion.
Explain a little bit when you say Bitcoin USD. Talk a little bit about what that means, how stablecoins play a role in this.
Stablecoins are really interesting. I mean, when they came out in 2017 or so, they became a better way to transfer dollars than the entire history of transferring dollars. So when you have one USDC, for example, there is a dollar sitting in a bank account or a short-term treasury, for example, that backs it. You can redeem it at any point for $1. Now, if you hold that USDC, you can send it to anyone and have it settle within 2 minutes, 5 minutes, 10 minutes, depending on how congested the chain is. And this is really important. Like, we have contractors in Argentina, for example, and they are able to get this payment. I can't even imagine the bells and whistles I would have had to, the hoops I would have had to jump through to get them cash if I was wiring them and things like that. So it's already preferred in places like LATAM, places like Africa, and that's a huge innovation, just making dollars more accessible to the world.
So let's talk about some of the potential risks. I know your background is as a security engineer. When you constructed this system, what were some of the risks? What were some of the concerns you had?
Oh, so there's two kinds of stablecoins. There's the collateralized ones. There's the dollar-backed versions of them, where every stablecoin has a dollar sitting in a bank account or a short-term treasury that you can redeem.
We hope.
Right. Some companies are better at auditing, like showing their audited books than others. So Tether is a little bit notorious for not being transparent about what's in their reserves. USDC does a better job. Gemini Dollar, which I co-authored at Gemini, does a very good job of that. Now, if there's a lot of money in short-term treasuries or medium-term treasuries, there's the risk of a bank run. And
by the way, just to give a little bit of framework on what that potential risk is, the challenge is that you have assets that are held off-chain, specifically U.S. dollar and dollar equivalent assets, treasury securities, sometimes commercial paper, but those assets are not obviously registered on-chain, and therefore the transparency to see the value of that collateral backing the stablecoin that you hold is very much an open question.
Right. So that's why a lot of these companies contract a third-party auditing firm to put monthly attestations to the balances in those bank accounts.
Which sounds very TradFi, right?
Yeah,
you
it's very
have
TradFi.
Accountants going through and verifying that they are in fact using pen and paper to verify that this is
right.
there.
But say for example a company issues a stable coin and they have all the money in 3-month T-bills or something like that. If they get a bank run, if everyone loses confidence that they actually have the reserves, even with the attestations, maybe they have to sell a bunch of 3-month T-bills and they take price risk. So that's that's an issue. Maybe there's not a dollar readily withdrawable, via wire. If I
This is liquidity risk.
Yeah, liquidity risk, right? That's a potential risk of the dollar-backed stable coins. Having said that, there's a lot of dollars that are just sitting as dollars, which is really nice there. That risk profile is night and day different from the programmatic stable coins, the under-collateralized stable coins, the on-chain nonsense, where it's not a dollar sitting in a bank account, it's like algorithms that are trying to keep a peg to a dollar. That was what UST was, if you guys ever heard of that.
This is the Terra-backed stablecoin.
Yes, exactly right. So that was the downfall. It was kind of an IQ test for a lot of people. I mean, I feel bad for the people who didn't have information who put money into that. Because if you put money into UST and then you put it in something called the Anchor protocol, it promised you 20% yields back in UST. The problem is people thought UST was always going to be a dollar. In reality, you were just getting 20% yields in UST, which was not a dollar. There was no dollar backing it. It was programmatically held to a dollar for some time, and then major flaws in its mechanism design came to light.
Right, and it effectively went to zero.
Yes, it did, and
people lost money.
Big time, and that's why 3AC. That's a big reason why 3AC, Three Arrows Capital, blew up. That's a big reason why a lot of retail yield apps, which the SEC has its eyes on now, rightfully so, blew up because they didn't know what they were doing. The people who founded them were just smart enough to lose everyone's money. They said, I'm going to bring crypto to the masses. I'm going to bring this 20% yield to the market for the average retail person. Because inflation's high and interest rates are zero, let's put their money into UST and let's get them yield. So it was a very dangerous situation. The risk profile of the programmatic stuff like UST is night and day different from the risk profile of a USDC or GUST, and they are a very effective way of transferring dollars, the collateralized dollar-backed stablecoins right now.
It's really interesting. We're talking about effectively the proliferation of these different types of digital assets, some with very, frankly, sketchy risk profiles, and we've actually seen some of those implode, and we've seen the economic damage it's done. We've seen the financial damage it's done to individuals and to entities that invested in them. How do you think about the total constellation of digital assets out there now, and how do you classify them? Like, what are your high-level buckets, for example, to start with stablecoins, that you put stablecoins in?
From a risk perspective, like a risk?
From a risk perspective, or just from a sort of core taxonomy perspective?
Yeah, so there are dollar-backed ones that are audited by third-party firms like USDC, like GUST, like the Paxos dollar, for example. And then there's everything programmatic, which I personally don't touch right now. I'm not a fan of those at all in the slightest, so I don't touch them. And then from the crypto asset perspective, people consider the blue chip, quote unquote, to be Bitcoin and ETH. I'm personally a big Bitcoin person, not financial advice or anything like that. I'm a dollar cost average Bitcoin person. Because the supply can't, it hasn't been modified. It's a rock. It's a digital rock. It does what it says it's going to do. It's decentralized. There's not a head. There's not even an unofficial head. There's not like there's no head, but we kind of know who the head is. You can't point to one person who controls it. And it's in a world where humans just keep pushing the boundaries, pushing, print more money, do more, invade Ukraine. Bitcoin is consistently, on its schedule, 21 million supply cap. And that's why I like it.
One of the interesting things about this space is, particularly for people who are new to it and who are coming from the outside, there is very much a kind of paradigm in the space where people who are involved in the Bitcoin space, particularly Bitcoiners, don't really find any of the other digital assets out there interesting. In fact, in many ways, they are very skeptical of things like Ethereum and some of the other innovations that we've seen in the space. We're talking about some of the innovation that human beings create, whether it's the financial innovation that created the 2008 financial crisis, or the innovation that led to, for example, the rapid spread of information via the internet. Obviously, when you have these periods of rapid innovation, you have risk, you have potential reward. How do you think about that, and how do you come down in terms of the Bitcoin versus everything else argument in the digital asset space?
It's a great question. So these people, the original Bitcoiners, they've been around since 2009, 2010. And so they've seen waves of scams. They've seen the same thing packaged up a million times.
Yeah.
And that's been the case. They were rightfully calling out things in 2014, tokens,
2014, in 2017, and in 2021. And they were right on every...
Right. Yeah, like people are not going to be paying an arbitrary token for a haircut, right? They're not going to be, you don't need to pump up the price of a token for decentralized Uber or something like that. It makes no sense, right? Bitcoiners have been right about that since day one. I think a lot of it comes from a good-hearted place. what muddies the water now is that there are real use cases of things like stablecoins. There's more effective ways to send dollars. And I think that kind of lens in which they have historically been right could use a little bit of updating in terms of, okay, if you're going to use dollars anyway, this is a more effective way of sending it. But in terms of trustlessness, Bitcoin, in my opinion, is still by far the most trustless. There are people involved in every other blockchain, which is, some would argue, against the ethos of why you need a blockchain in the first place.
This is true decentralization that Bitcoiners very often cite.
Right. Yeah, and that's a debatable statement for a lot of people. Some people argue that Ethereum is more decentralized. I tend to fall.
That's why I said as they cite.
Yeah, exactly. Yeah, exactly right. Yeah, I tend to fall in the Bitcoin camp there.
Yeah. So you talked a little bit about stablecoins. You touched on the cross-border remittance use case, which is obviously a very significant portion of the use case for why dollar-backed stablecoins, for example, are so valuable.
Yeah, I mean, certainly. Like, it was what our Argentinian contractors wanted to use on day one. It's what we wanted to pay them in day one. We avoid so many headaches from doing that. Even interpersonally, it can be more pleasant than a Venmo if you're sending large amounts of dollars.
Yeah, I think Venmo is capped. Is it $4,999.99? I think is the Venmo cap.
There's a cap. Yeah, exactly right. Whereas with USDC, there's no cap, which is really nice.
One of the interesting things when you're talking about, for example, paying contractors, and one of the things that I think is interesting about the dashboard that you've created is, historically, and I've been in the space since 2017, this was very much a space where individual investors, individual enthusiasts really played a very dominant role. But what's interesting to me is about bridging some of the gaps between regulated entities here in the United States that have reporting requirements, that have traditional banking relationships. This expansion of this technology into a regulated entity space. Talk a little bit about that and how you see the role of Meow in that context.
Yeah. So what's interesting is that when crypto was just getting mainstream, retail is the early adopter to everything. So there were companies back in 2013, 2014 who directionally knew institutions were going to come to the table. So they built their entire company around institutions. But the reality is retail is the early adopter, and institutions like to trade against retail users on the platform. So you needed to get the retail users on first. So wherever the retail users go is where the institutions go. So that's step one. Step two, we're in a very different world now than we were in 5 years ago. Now, the government's not messing around. They have their eyes on this. So you need to be
talking about the crypto space.
Yeah, certainly. Yeah, and even the banking space, unrelated to crypto. I mean, the government is really locking down all the cowboy stuff that's been going down. So institutions do care, and it's the only right way to operate is within the confines of the law.
Well, they've really had no choice because we've seen retail investors lose money, and we live in a democracy, and people get upset and they vote,
right.
And they complain about a lack of transparency in some of these protocols. People, feel that there are those who feel, obviously people in the crypto space feel very differently, but there are those who feel that government should play a more vigorous role in regulation of this space.
Yeah, and I understand that it's tough because what is a blockchain? It's a decentralized kind of form of government, effectively, right? And then you're introducing government on top of that. How do they what's the happy medium? Is there a happy medium? So these are really interesting questions that you need to answer. But things that are blatant scams, like putting people's money into UST, it's egregious behavior. I mean, that needs. I think we'd all agree that's ridiculous, and you need to get rid of that.
Yeah, and I think the interesting thing is when you are a regulated entity, when you do have when you're a medium-sized business, for example, or a large business, obviously you have tremendous requirements in terms of accounting standards. Obviously, all of this needs to be documented, and they need to be compliant. And folks who are in those roles, who are responsible for shepherding those organizations through those regulatory hurdles, are obviously very mindful of what those risks are.
Yep, and that's a big part of what the SEC wants to see. For example, they want to see. I mean, I can't speak to what they want to see specifically, but we go after accredited investors, for example. We don't face retail on Meow. All the corporates we work with are accredited. We do a very good job of laying out all the risk factors of everything that's listed on the site. So these are things you can do as a company, and it's the right thing to do in my opinion.
Where do you think we are in that process more generally of onboarding corporate entities, financial entities that are regulated that need that type of compliance?
The question is why would the financial entities need to have some motivation to participate in the crypto world in the first place, right? In this high rate environment where risk-free rates are 4.1, 4.2%, they're not clamoring for yield. They're not clamoring for crypto associated yield. maybe they're more interested in holding Bitcoin, holding ETH. Maybe they're interested in staking ETH, something like that.
Talk a little bit about ETH staking. This is obviously a major change that we've seen here with the merge. This is the shift from proof of work to proof of stake. Now ETH is no longer secured via transactions the way that Bitcoin still is. Many people in the Bitcoin camp believe that the proof of work is a much more secure way of securing a blockchain. But we've migrated in the Ethereum space from proof of work to proof of stake, and this is a very interesting topic.
Yeah, so if you stake your ETH now, you don't get diluted as much from new ETH entering the supply is the idea. So it used to be proof of work, which meant people are mining, which meant people are buying these hardware, these GPUs to run constantly to try to find a random number, basically.
Yeah, so basically, when blockchains are secured by mining, as they are under proof of work, you have large processors continually just churning through math problems to prove, hence the proof of work, that these transactions are valid. It's a very energy inefficient way of doing it. Creates a tremendous amount of energy consumption. Moving from proof of work to proof of stake in Ethereum is a paradigm shift in a very dramatic way, which allows people to back a chain by staking their own ETH and then generating yield from it.
Yeah, the energy argument is actually pretty interesting because a lot of Bitcoiners, myself included, think that proof of work can be a net positive for like renewable energy development, for example.
Talk about this because it's a very controversial view.
It is, yeah, and I don't think it's like talked about as much as it should be. But there are so the problem with renewable energy sources is their intermittency. Sometimes they generate too much, sometimes they generate too little.
Solar and wind being
right.
the obvious example. Sometimes the wind's not blowing and the sun is under.
Exactly, exactly right. So in somewhere like Texas, for example, in a free energy market, it's difficult to have a predictable load to power the grid with unpredictable energy sources. But what Bitcoin introduces is a feasibly modifiable load on the other end. So Bitcoin miners don't have to stay up 24/7. So say like the wind's not blowing as hard as it should be, the sun's not shining as bright as it could be, the grid operators could call Bitcoin miners and say, hey, we'll pay you if you lower your consumption here. And Bitcoin miners, so long as you're getting paid 1 penny more than what Bitcoin would have paid them for mining during that period, happily do so. That's what's called a demand response program. And that makes it more viable to introduce more renewables on the other end. If you have more miners on the other end, you get more wind and solar on the other end.
And conversely, if the wind is blowing at 3 o'clock on a Tuesday morning, you can mine more Bitcoin as a consequence of the additional supply.
Yeah, you can turn on more miners. Exactly right.
Yeah, and the flip side of this argument, people say there's no way that you can actually decrease the amount of, for example, carbon generation, carbon consumption, and fossil fuel burning by actually doing this. So this is the argument in the space that's happening today.
Sure. Yeah. If there's it incentivizes people to like make renewable sources, put them to work. If there's like a hydro plant that's not doing anything right now, or just downstream water, suddenly you can not productize it, but there's an incentive, there's a financial incentive to make it produce energy for the world. So I'm a big believer in this camp. I saw it firsthand. We developed these programs. It is controversial, just to be clear, but I don't think it's as black and white as Ethereum's good for the environment, Bitcoin's bad. I think that's not even an elementary, view of the situation.
So we have a few minutes left. I think we're going to do some questions from the audience shortly. But talk about what your view is of the future. Where do you see this technology heading in the next 1, 3, 5 years?
I'm very bullish on stablecoins. So I think I don't see that level of innovation coming from traditional, just fintech, traditional like Fed wire programs, the Fed fostering anything like that. So the ability to move money 24/7, settle instantly, earn yield potentially from a decentralized place. Money is liquid in crypto markets, which is very exciting, and stablecoins make that possible. I think we're just at the beginning of the innovation they'll bring. So I'm very bullish on that. I'm very bullish on the Bitcoin that I hold personally, and dollar cost averaging into it personally, not financial advice, because I think the world only pushes for more and more printing. On a long enough timeline, what's going to happen to interest rates? They're not going to be up this high, in my opinion, for too long. So stablecoins, I think, are going to foster it. But yeah, I mean, I don't think the government has a choice. I think at 5%, we run into some serious problems.
I guess unless you see inflation at 12.
Yeah, I mean, who knows at this point? It's anyone's guess, yeah.
So talk a little bit about what you're going to be doing at Meow in the next, for example, 1 to 2 years.
Yeah, so we talked
What's
a lot
the product roadmap.
We talked a lot about crypto and this. Meow doesn't want to be long or short any yield source. We don't want to be long or short interest rates. We are a dashboard for every yield source you could want, be it fiat, be it crypto. And fiat's a lot more attractive right now to most people.
Right.
So commercial paper, et cetera, like there's not a single place that you can just consolidate all this, have accounting integration, have multi-user accounts, read-only access, do it in a compliant way, clean way. That's what meow.co does.
What are the new functions or features that you foresee coming in the next year or so?
It's interesting. We'd like to automate a lot of the functionality, like I mentioned. So we'd like to be able to analyze things like your burn rate, analyze where your costs are coming, your accounts payable are coming, and kind of give you the one-stop kind of solution for maybe this portfolio is interesting. Really tailored to you. Cutting out a lot of the middle people that you would need for that normally, a lot of the bureaucracy you need for that.
So now that we've talked a little bit about the view that you guys have in terms of your product roadmap, more generally speaking, what's your view of what's going to happen in the digital asset space? What are some of the risks? What are some of the opportunities?
I think we're going to see a lot more regulation coming, at least over the next 2 years. So this administration has taken a certain stance on, and this is not a political statement at all, it's just taken a different stance than the previous one. And this could be the new normal. And depending on where your ethos is, you could say this is totally justified. I think we'd all agree on things like UST, it certainly is. So we're going to see a lot more crackdowns, a lot of the people operating in a cowboy manner, getting in trouble. And you're going to find a steady state of like, where's the innovation? You're going to find a steady state of companies needing USDC for more of their payroll operation, for more of their bill pay, things like that. So that's what I predict. I think the Ethereum staking market is going to grow. I think institutions are very interested in that.
Do you see any specific use cases coming with Ethereum that might be coming at scale or become more mainstream as a consequence of that staking?
It's interesting because a lot of Ethereum's use cases, so DeFi, for example, the promise of DeFi is cutting out middle people, allowing you to lend unsecured or over-collateralized without 3 people in the middle of you taking part of that spread, right?
Let's define DeFi for people who may not know.
Yeah, DeFi
Can I interrupt for a moment? Because one of the questions that came in was about DeFi and how there have been some news headlines that consumers and investors don't have high trust, so they aren't investing in that. So can you address that as our audience Q&A?
Certainly, yeah. So DeFi just allows you to, for example, lend to someone you may or may not know. And if you do it unsecured, it's just you and that person. And that person is abstracted away by an address. So you don't know the identity of the person. There's no identity on chain. So here's one of the problems.
And it's important to point out the reason that might sound incredibly risky. Why would I lend money to someone I don't know if I don't know their address? If I can't extrapolate from their address who they are and assess their creditworthiness. But the idea of DeFi is that there's programmatic execution. Once the smart contract has been executed, it's basically programmatic, so that someone can't say, well, I'm not going to pay you. It's built into the smart contract if, for example, it's collateralized.
Yes, if it's collateralized, exactly right. So you could programmatically lend to someone you don't necessarily know, get collateral back from them, and that's totally programmatic. There's no trust in that relationship. Well, there's very little trust is what I would say, because you own more
well, the trust is in the smart contract.
In the protocol,
The trust is in the protocol,
exactly.
And not in the counterparty.
Exactly, and a lot of these are tried and true, I would say, quote unquote, because they have not failed in 10 years, even like through these 6 years, even through these crashes. So that's the thing about over-collateralized lending. So you lend out, the protocol gives you collateral back, no trust related to that. People are not flocking to that right now because the rates on those over-collateralized offerings are 0.5%, right? People are not really going into that right now. Unsecured lending in DeFi is also possible. You can lend unsecured to someone. Now, the big problem there is there's no concept of identity on chain, like I was mentioning. Identity kicks in, credit scores kick in when you don't have collateral. When it's unsecured, you need to know who you're lending to some extent, right? And the problem is if that person doesn't pay you and you lend to them unsecured, what's your recourse? If they're in Hong Kong and we're in New York, you're going to get a New York court to say, yep, this makes sense. This is a DeFi protocol, unsecured loan. We're going to go after them in Hong Kong. I mean, good luck with that.
And you may not even know who they are.
Right, and it's difficult to find. A lot of the C DeFi world is pretty interesting. It's centralized DeFi. There's protocols like, I don't want to name any by names, just for now. But there are ways in which you have a basically centralized entity in a DeFi world, which picks who the unsecured borrowers are. So if you were to lend into a pool of these unsecured borrowers, you would at least know who the people are who are borrowing, but it's still unsecured. So the problem is if one of them defaults, you would still have to go to a court and tell them, I participated in this DeFi protocol unsecured, have them follow the trail. And I don't think we've had one instance of that on-chain court resolution having happened yet. So it's still in its infancy, but that there is promise there because you're at least cutting out middle people involved in lending unsecured.
Well, the other interesting thing about the question, it was about the risks inherent in this. And I think the other point that we haven't touched on yet on DeFi in terms of risk is that obviously we have seen a whole series of very significant security flaws in these DeFi protocols where the protocol itself was not trustworthy, or there was a mechanism, for example, taking a flash loan and borrowing against collateral in the same coin, where we just saw one earlier this week called Mango, where the theft was, I think, over $100 million. The folks who actually executed that call it a trading strategy, there's some question now about whether or not regulators are going to agree with that view. But talk a little bit about some of the security concerns. I know you have a background as a security engineer, but we have seen, probably 5 or 6 pretty significant $100 million plus security breaches in the DeFi space within the last, call it 3 or 4 months.
Yeah, I hesitate to call anything blue chip because everything is kind of in its infancy, but there are protocols like Compound and Aave which have run like a clock. They have a lot of value in them, like tens of billions, and a lot of eyes on them 24/7. Then there's places like Solana, there's places like Avalanche, there's bridges, there's new DeFi protocols. A lot of these are propped up, by the way, in bull markets. So they'll issue a token, VCs will get excited, they'll want to speculate, they'll encourage people to deposit into them. They're not audited, or maybe they are audited, but they haven't been around that long. These are the ones that are susceptible to hacks, and they're very complex systems. I want to give credit where it's due. They're extremely complex, but I wouldn't be able to sleep at night personally if I had my money in some of these DeFi protocols. Now, there are some blue chip ones, like I mentioned, quote unquote, that I'd feel a lot more comfortable. There's a wide gap between the blue chips and the new ones, especially on different chains that are not Ethereum, if we're being honest about that.
I don't know if we have any other questions.
You nailed it with those last couple of insights that you shared. And we actually put out a little poll as everyone walked into the room. There was a question, how comfortable you are putting some of these strategies onto your balance sheet. And it was all over the board. So wherever you're at, whether you're a newbie, whether you're scared, whether you're an expert, whether you're excited, you're not alone. You're on the spectrum of where everyone else is. So can you give one last tip? What should someone who's really new to this, what should their very first thing to do, what should it be?
I want to know if we've terrified people or if we've reassured them in this conversation, because obviously there is a lot of risk in the space. But to the point, a final sort of takeaway in terms of what people who are new to this conversation, who've heard a lot of benefits, a lot of potential risks, how would you frame that context?
Yeah, I don't think you should force anything. I don't think there's a mandate to be looking for DeFi yields or anything like that. The truth is, in a low rate environment, which I think we'll get to soon enough, it'll become top of mind, and we have plenty of time until then. And the space is going to be super mature. It's going to be, compared to now, it's going to be much more mature. So you got some time to think about the strategy and stuff, and I imagine it's not top of mind for you now, and who can blame you given where the quote-unquote risk-free rate from the government is. So
any next steps for people who are just curious about learning more, how would you guide them in terms of direction for learning more about some of these ideas we've
Sure, I think the over-collateralized part is super interesting. I would look into the Compound protocol, for example. That's considered blue chip in terms of the DeFi protocols. So that's over-collateralized borrowing and lending that takes place on-chain without a middle person. If you can understand kind of the mechanisms of that and why people are comfortable with it, that'd be a really good place to start.
Wonderful. Thank you guys so much. Give them a round of applause as they exit the stage. Thank you for your insights.
Thank you.
All right, coming up next.